I'm a bear. I'm a perma bear, and I think this virus is bad, and I think stocks should go down, and I think companies should fail. But I think that on the other side of this, things get really good, and I can be bullish too.
Hi, my name is Georgia Tucker with Cambridge House. If you've attended our conferences, you may recognize me from the newsletter walking tours. Today, I'll be talking with longtime Cambridge speaker Nick Hodge, founder of the Outsider Club. We'll be discussing post-COVID-19 markets, gold, and how he's de-risked his portfolio. We'll also be talking with the president and CEO of one of his favorite companies, Quin with Midas Gold. Hope you enjoy the video. If you want to see more about precious metals investing, please like and subscribe. So at the end of January, you were on our stage at VRIC. You've been speaking at VRIC for years now. You were very confident that a gold bull market had begun.
The past couple of times I've spoken at Cambridge, I was talking about why you should stay calm and buy gold stocks even though they hadn't broken out yet and even though we were not yet in a gold bull market. We are now in a gold bull market.
Now, of course, a lot's happened since that conference in January. So are you more or less bullish than you were in January on gold?
Definitely more bullish on gold than I was in January, but there's a big caveat, and I'll get to that in a second. But look, if we were talking about global debts and interest rates and the Fed coming back into the repo market, which they had already done before the virus broke out, then all that stuff has just been multiplied by a giant factor at this point. I mean, the monetary response has been huge, whether you look on the fiscal side with the relief packages or you look on the Fed side with cutting the rates immediately, going to unlimited bond buying, enlisting BlackRock to buy debt. I mean, they've really just taken it all the way immediately. And it would be my opinion that we've still got a lot of fallout left from this virus. Now, some people say don't fight the Fed, and that's been true for a while. But here you've got gold telling you that they're kicking the can down the road. It might be coming to an end. Now, that might be is my caveat, right? Because while we had stocks fall off a cliff, go down 30% immediately, they have retraced half of that gain. The bulls are feeling pretty good. The bulls in broad-based equities I'm talking about now. And are saying, it's going to be a V-shaped recovery, et cetera. And so I think every gold bull's worry is that the Fed can paper this over again. But I think the damage came so swiftly, and I think that the damage from the last financial crisis had only been papered over at best, that those problems are going to re-expose themselves.
And I mean, in regards to COVID-19, is the market reacting in a way that you'd expected? Can you compare this to previous crashes, or is this a pretty uncharted situation?
The market has reacted in all sorts of ways, and you really got to break that apart when you're talking about the market. So the dollar has done as you'd expect, right? I mean, the dollar has, along with gold and treasuries, been one of the strongest performing asset classes in the first quarter of 2020. And so in that respect, I think, it's played out as you would expect. Dollar strong in a crisis. In other respects, I don't think it's entirely played out yet. I just mentioned that the stocks, the S&P 500 has retraced 50% of its loss. You asked if you should compare this to sort of other crashes. Yeah, let's compare it to 2008, for example. I mean, stocks went down, 56, 57% after the 2008 crash. We haven't seen that here. We only saw a 32 or a 33% fall in the S&P. And yet almost everything you read says this is like the worst thing ever, right? The worst retail sales ever, the fastest pace of job losses ever, worst things since the Great Depression, worst things since World War II. And so if all these things are the worst, how can the stocks only go down 30% relative to the 50+% they went down in 2008? And in that capacity, I think we're in still a bear market for stocks and have a long way to go because the entire world is still locked in their house. How can you talk about a recovery or a V-shape when the lockdown itself is still going to extend for a couple of weeks? And then, there's no way the jobs come back as fast as they went away. If you're a business owner and you just fired 50 people, you don't rehire 50 people. You rehire 20 or 25 and see how it goes. And then, of course, we're going to see this trickle to earnings, which we're getting Q1 earnings now, but that only really encompassed 1 month of the virus. It wasn't really lockdowns didn't come until March. So, Q2 earnings are going to be really bad. And I think this, even if we stop the virus in its tracks, get a treatment and or vaccine and start getting people back to work, events have set in motion. Events have been set in motion. Cycles have been set in motion. Things have been set in motion that need to be unwound as it relates to, credit and debt and other things. Frankly, a stock market that was at record highs when 40% of the companies weren't profitable, and that was before anybody knew what a coronavirus was. So, we should compare it to other crashes. And if you want my take on the direction, I think still bear market for a while.
Because I know you'd written just a week or two ago in your newsletter, The Outsider Club, that you speculated a potential looming depression, but you were arguing that we could go higher or lower.
I think what I meant by that was, if you look back to the Great Depression, stocks had some of their best up days ever in the Great Depression as well, in the 30s and 40s. And so those are bear market rallies. There's going to be up days and maybe even up weeks, but the overall trend, I think, is down for a while.
Do you expect to see $2,000 gold this year in the short term?
Of course, I think $2,000 gold is on the way. Let's talk about first where we've been, and then let's talk about where we are, and then we'll talk about where we're going. So, you mentioned I gave a talk at the Cambridge House, VRIC in January, and one of the charts I talked about there was, all the gold bugs were sort of disappointed that we couldn't get above sort of like where we were then, the $1,650 an ounce level.
In the early part of 2020 so far, it was able to bust through that barrier. And then you can sort of see the next level of resistance it got to very quickly. And that's where we're sitting at now. That's like the 1560 level of resistance. And it shows me that, people want to own gold, and that, for the first time in a long time, this isn't a false start.
And I had a chart saying, look, for the past, 5 or 6 years, gold was trying to break through $1,350 an ounce. Think about that, $1,350 an ounce. Gold tried to break through in 2016 and 2017 and 2018, and it never got there. And then last year, 2019, the gold price broke right through $1,350 an ounce and went to what I just said, $1,650 the last time I saw you in January in Vancouver. And I was saying then, look, it's taken us forever to get through $1,350. Let's first of all enjoy where we are here now, because it's $200 or $300 above where we were just a year ago. And a lot of the companies that we invested and speculate on modeled their projects at whatever, 1,150 gold, 1,250 gold, 1,350 gold. And here you have prices much higher. So let's enjoy that for a second. Now, when you pull back even further, what you'll see is that gold is now sitting at a 7-year high. So the price we're at now, just below, call it $1,700 an ounce, we haven't seen since 2013. And so we're running into that last bit of resistance, right? 2011, 2012, that's when gold went to its last record high, right? Over $1,900 an ounce. So I think the next $200, call it $150 an ounce, are important, because we're going to run into resistance where gold topped out last time. And if we can get so the first part of the answer is, I think we get to 1,800 quite easily over the next, 3 or 6 months. And then what happens at 1,800 sort of dictates or determines what comes next. If we can break through 1,800, which I think we'll do for reasons stated earlier, how all the deaths and the money printing has been exacerbated because of the virus. If we can get through 1,800, well, guess what? Gold is back to record prices in U.S. dollars, and there's not much stopping it. Rising it past there. Now, to answer your question directly, yes, I think gold can get $2,000. Don't kill me if it doesn't do it until January or February 22, right? The question was this year. But more importantly, I think we're firmly in an uptrend. I think gold goes higher. And sort of inverse to what I just said about the stock market, you can see gold down $50 or $100 in a day. You can see gold go back to $1,650 an ounce or $1,600 an ounce and still be firmly in a gold bull market. And I think that's where we are. And the last part of the answer, I think, would be what happens after $1,800 or $2,000 gold. Well, the foundation for that is being laid now, right? So we need to see what the fallout and the response of this virus continues to be. Gold plays multiple roles in my portfolio. It's a safety net and an insurance policy when we're talking about the bullion part of it, right? The coins. And then it's an investment if we're talking about like the royalty company component of it, the Franco-Nevadas and the Wheaton Preciouses of the world. And then it's a speculation if we're talking about, the company we're going to talk to in a minute, Midas Gold, or lots of the other things that I write about. And frankly, lots of the companies that are at the Cambridge House conferences, right? They fall into the speculative part, which is frankly the part of the market I like the best and have spent the most of my time learning about and investing in and writing about.
Well, another thing you'd mentioned in January of your AC was that the majors would need to replenish their resources and that this could be a catalyst for M&A.
And the majors really do need to replenish their reserves. I know this is a common trope in the industry, but it's one of the reasons you've seen the M&A recently, and it's one of the reasons you've seen a lot of companies, do these mergers and acquisitions to consolidate assets and bring new resources and reserves into their coffers.
So do you expect to see M&A pick up in 2020?
You got a lot of mines shut down right here, right? Across the world, North America, South America, Africa. You got Africa's got a significant amount of debt to China. I don't want to go down a geopolitical rabbit hole, but China I think is going to take control of some African assets as a result of this. We'll have to see how that plays out. It might take some African assets off the table for M&A. A lot of large miners aren't producing right now just because, as I said, a lot of mines are shut down. And so it'll be interesting to see how long they remain shut down for, what that does to their cash flows, what that does to their balance sheets, if they're in a position to be able to acquire, right? And so that's why I don't know. The second part is, gold's at 7-year highs. And so let's just take Midas as an example, because I know we're going to talk to Midas. $300 ago, when gold's at $1,300, you might seek to be acquired because you might not be able to raise all the money to put the project into production because the gold price isn't high enough. And so you need a bigger partner to acquire you. But with gold at 7 years highs and going higher, maybe now in this case, and we'll ask Stephen, Midas can raise the money and build the mine on its own. And so in that scenario, it doesn't need to be acquired. And so while the answer is yes to part of your question, do the majors need to replenish their reserves? Yes, absolutely. Are they going to be able to, I don't know, a company like Midas and its shareholders would I think want to keep the cash flow and asset to themselves if they could, and not sell it prematurely to a major. And so it's too early to tell, Georgia, I think is the answer to your question, but those are the factors I'm watching to help me come to an answer when it's time.
Hi, Stephen. We can see you.
Hey, Stephen.
Yep.
Well, thank you so much for joining us today. Before I hand off Nick for the questions, I just had one last question for you, Nick. You've been talking about Midas for years at the Cambridge House conferences. Why have they kept your attention?
Well, it all started really with the asset. It's a superlative asset, and at the time I was looking for assets that were going to have long lives and provide good cash flow, and that ultimately were going to be a mine. And I found that in Midas. Stephen can maybe run through a couple of the superlatives, but it's got a very rare combination of size and grade that really attracted me as far as where it can fill the vacuum of sort of that like mid-tier production immediately, throw off a lot of cash flow and also have a very good shot at getting permitted because of the jurisdiction that it's in and because of the jobs that it is going to create. And so I have been recommending and writing about Midas for a while. I've interviewed Stephen plenty of times, as most recently as last week, and it's exciting, and I'm glad I did stick around because you can really sort of see the end of this permitting process and the project coming to fruition. So I'm excited to talk more about it. Well, Stephen, that's sort of a good segue right into it. You and I talked recently. Why don't you, I guess, before we get into what's going on with the company, can you just give us a quick snapshot of Midas, sort of the scope and scale of the project?
Sure. So when I first looked at this project way back in late 2010, got involved in 2011, what I saw was a kind of unique combination of a potentially very large, long life, good grade project, but also one that had a big environmental positive impact because of the brownfield nature of the site. We can come back to that a bit later, but talking about the potential of the project, the challenge, like a lot of old mining districts, in this area was mined from the 1920s through the 1990s, off and on, is the land ownership was very fragmented. And everywhere anybody had done some work, they found gold, but they couldn't cross the boundaries because it was somebody else's land. And so you had this real patchwork of pieces. And we were able to consolidate the entire land package into one big coherent package and realize that there was a large-scale system here, or a series of systems, and we drilled extensively for off and on for about 5 years, and we've ended up drilling off a 6.6 million ounce resource. So this is 3 times the average grade of the typical open pit mine in Nevada. So it has scale and it has grade, and that translates through when you get into the pre-feasibility study we did. It shows a mine that's going to produce 340,000 ounces of gold a year for at least a dozen years, with cash costs down in the $600 all-in sustaining cost range, which is just a very large scale mine, and that's over a dozen years. So large scale, low cost, long life, and that's a pretty rare asset, and it's in America.
And it's in America. That's right. It's in Idaho. So you mentioned some of the numbers there. Low cash costs. Also has a robust NPV and IRR, even at the levels done in that 2014 PFS. You also mentioned the 6.5 million ounces of gold. And so here we are in 2020. You want to obviously bring this project into production, and so you've spent the better part of a couple of years permitting this thing. And of course, none of us like permitting to take as long as it does. And none of us have been happy over the past 12 months as the timeline for permitting with the U.S. Forest Service has been expanded. But, sitting where we are sitting now with the price of gold where it is, can you talk a little bit about the timeline from your point of view? And you and I have talked about this in other interviews, Stephen, but sure, in a very real way, you're coming to your draft EIS this year in 2020, record of decision in 2021. At the same time, it's looking like it's really going to dovetail nicely with a new bull market in gold.
Yeah, for sure. And, maybe it's better to be lucky than smart. And one of our big investors said that, his biggest fear with development companies is, they get a feasibility and they want to build a mine when the gold price is low, and they dilute their shareholders massively. So in some ways, he's not unhappy that the permitting has been delayed because it's postponed us into a bull market. So, there is a silver lining to everything. But when we got into the permitting process, we perhaps naively assumed that doing a good thing and cleaning up a brownfield site should lead to a more speedy permitting process. And I would say if anything has happened, it's been the opposite, and no good deed goes unpunished. So, you go out and offer to clean up a site that's a massive mess and nobody's going to do anything about, and that just adds to your permitting process. And yes, it adds complexity, but it's just been challenging. But we're coming towards the end of that process. So as you mentioned, we should have a draft EIS out in Q3 of this year. So, with the next, not too far away from now, and then a final decision, recorded decision in Q3 of 2021. So, less than 18 months from now. So, we're coming towards the end of that process. And, what we've really seen, and this is maybe a topic you want to touch on a bit later, is, with this current crisis is, the attention on how is the economy of the country going to recover from this crisis. And everybody's sort of woken up, and instead of being complacent, hey, the economy's booming, everybody's got a job, there's low unemployment, what's the problem? What does it matter if it takes longer? Is that, you're seeing the reattention on, we need jobs, we need them, we need capital investment, we need people to be employed, we need to get the country working. And I think that's sort of filtered through to agencies and everybody across the spectrum of, and this project could be a huge winner for the economy of Idaho. We're talking 1,000 jobs, high wages, and long over, and that's over a 15 to 20 year period. It's a big long-term economic positive impact.
I did want to talk about it later, but let's just pull it right up now. So one of the things I wanted to ask you about, it was sort of twofold. One, I see a lot of mines shut down now. I see a lot of development projects put on hold. I see a lot of drilling campaigns stalled. Midas doesn't have to deal with any of that because Midas is permitting. And so thankfully you have a lack of operational risk right now. And then the second part of that question, it had to do with the jurisdiction. And I was going to ask you precisely that, with 22 million Americans already out of work and millions more definitely to come this week and in following weeks. I've got to think that a mine that, you'll correct me if I get the number wrong, is going to bring something like $1 billion in economic activity to the state is going to be a welcomed project.
Yeah, for sure. And, to sort of the first point is that, what you're seeing is, the real focus on moving things forward and, across the board. And, it's the amount, is $1 billion, and 1,000 jobs, related directly to the mine site. But, most of that equipment is going to be purchased in the United States. Is it Caterpillar trucks or is it Komatsu trucks? But they're built in the United States anyway, under license. So, they're American jobs. And so, there's a lot of pent up potential in the mining sector. And the key thing is it isn't dependent on government grants or government largesse. This project's economic at way lower gold prices than it is today. So, just get us through the permitting process and we can go create those jobs and make that capital investment and get things moving forward.
Stephen, that's the here and now. I want to talk to you about earlier days in Midas's life and some of the investors you were able to attract. I obviously came into the story years ago, but there were people there before me, like Franco-Nevada, for example. I believe this was the earliest stage royalty they've ever bought, which really speaks to how they were able to recognize what a quality project you had so early. And then over the years, you've had Barrick come in and take, I think now they're at 20% of the issued shares, 11% on a diluted basis. Of course, one of the biggest gold producers in the world. And then really a name I need to mention is John Paulson through Paulson & Co., which now owns 43% of your company on a diluted basis. And I'd be remiss if I didn't point out in the current environment that there have been books written about John Paulson for the so-called greatest trade ever made in Wall Street, for how he played the 2008 crisis. And so if I'm looking at what a billionaire is doing with his money, especially one that made it through the last crisis quite successfully, and then I'm looking at what Paulson & Co. has done in Midas, not just long ago, but very recently as well, putting another slug of capital into the company. I'd just like you to speak to those three high-quality early investors you've had and the stamp of approval that has to lend to your project.
Sure, and I think that it really comes down to the same theme for all of them. It's the quality of the asset. Just to put it in perspective, if we were in production today, we'd be between the third and sixth largest gold mine in the United States. We've got one of the largest resources and reserves in the resources and reserves in the United States, and one of the highest grade open pits. We're about the seventh largest reserve, about the fourth highest grade open pit if we were in production today. Our all-in sustaining costs are way in the bottom quartile of the entire global industry, worldwide. And so, that kind of quality asset attracts people. But I think the icing on the cake is And we borrowed a chart from Northern Star that they put out when they bought the Pogo mine in Alaska. And the chart basically showed that there are only 18 mines in first world countries producing more than 300,000 ounces a year. So, and only 5 of those in the United States. So we'd be the 6th 300,000 ounce plus a year mine in the United States and the 19th in the first world. It's a pretty rare commodity, and from a cost perspective, scale perspective, but it's also in the first world. So your geopolitical risk is substantially reduced compared to other jurisdictions. Obviously, the downside is the permitting takes longer and costs more than perhaps some other jurisdictions, but you have geopolitical stability, and so you've got a premium asset in a premium country, and the market will eventually recognize that, and we should all be rewarded for our patience.
In summary, thank you for coming and touch quickly on the sensitivity, because it's something we haven't mentioned yet, but the PFS, correct me if I'm wrong, but I believe it was done at 1,200 an ounce gold. Here we're sitting 1350 was the base case, excuse
50,
me. So at the NPV was 800 million then at 1350, and at 1650 the sensitivity goes to 1.4 billion dollars, and here Midas is sitting between 100 and 200 million dollar market cap, and that's sort of the runway that I keep reminding my readers of, and that's the reason I continue to be a Midas a shareholder and supporter, and like you, of course, looking to the end of this permitting process.
These kinds of gold prices, it's a spectacular project with a spectacular return. And as I mentioned earlier, maybe the timing is all lining up, and if we get our permits into a high gold price environment, that's the best of all worlds.
Really appreciate you taking some time today. Just before we go, if our viewers want to hear more from you, Nick, or more from you, Stephen. Nick, where can they find you online? How can they follow you?
I've got 2 websites you can go to. One is outsiderclub.com. You can sign up for the free daily e-letter there. And if you like the resource sector specifically, resourcestockdigest.com, where we host interviews with quality companies like Midas and others to help you in your due diligence process.
Awesome. And how about you, Stephen? If our viewers want to learn more about Midas, perhaps you can share the ticker symbol also with us?
Sure. So the symbol is MAX on the Toronto Exchange, and we're also very actively traded on the OTCQX. So that's MDRPF. And we trade actually more on the QX than we do in Toronto. So it shows a very strong retail interest. And the best place to go for information is our website, which is midasgoldcorp.com. But if you want to get into more sort of local interest, is go to Midas Gold Idaho website, which is more locally focused and has a lot more social media. We have various places you can connect into the various events that are happening as time progresses.
Awesome. Well, thank you both so much. Really appreciate your time, and stay well, stay healthy, and we'll chat to you soon.